All right, let's talk about investing. If the whole world of finance just feels, I don't know, overwhelming or like it's for other people, you're in exactly the right place. We're going to break it all down step by step and hopefully take you from a place of confusion to a place of real confidence. So here's our game plan. First, we'll cover the super important stuff you got to do before you invest. Then we'll get into the passive philosophy, kind of the big idea behind all of this. After that, we'll look at the actual tools of the trade, indexes and ETFs. Then we'll figure out a game plan with the strategy, asset allocation. And finally, we'll wrap it all up with your first steps to actually make it happen. Okay, let's just dive right in. Before we even whisper the words stocks or bonds, we need to talk about you. Because, and this is so important, the questions that are going to make the biggest difference to your financial future, they have absolutely nothing to do with the market. So let's just get right to it with a tough question. Is investing really your main problem right now? For most people who are just starting out, the answer, believe it or not, is no. The things that will actually change your life, the real challenges, they almost always happen before you put a single dollar into an investment. It all comes down to this stuff right here. You've got to have a handle on it. How much money is coming in? Can you make that number bigger? And maybe even more important, how much is going out? Where can you trim the fat? Because if you don't have a positive cash flow, more coming in than going out, an investment strategy is kind of useless. It's like trying to fill a bucket with a hole in it. You have to know your goals first, or you're just driving without a map. All right, so once your own financial house is in order, then we can talk strategy. In this next part, we're going to dig into the core philosophy behind all of this. It's called passive investing, and it's all about why trying to be the smartest person in the room can really end up costing you. When it comes to investing, there are really two main camps. On one side, you have active investing. The goal here is to be a superstar, to beat the market by picking the next big thing. It's basically a full-time job. On the other side, you have passive investing. The goal is way simpler. Just match whatever the market is doing. How? By owning a little piece of everything. The effort is super low. It's kind of famous for being a set it and forget it approach. So which way is better? Well, just look at this number for a second. 90%. That is, roughly, the percentage of professional fund managers, we're talking highly paid people who do this all day, every day, who fail to beat the market over a 10-year stretch. Let that sink in. If the pros can't do it consistently, what are our chances? And this really gets to the core problem with trying to pick winners. It's this question from Nick Maggiulli. How do you know if you're good or just lucky? I mean, think about it. You could buy a stock and it could triple in value. You'd feel like a genius, right? But was it skill? Or did you just get a lucky roll of the dice? You might never, ever know for sure. Now, there's a fancy-sounding theory behind this called the efficient market hypothesis. It sounds complicated, but the idea is actually really simple. It basically says that any information you can find about a company is already factored into its stock price. That hot tip you got? Yeah, millions of other people and their supercomputers already know about it. It means there are no $100 bills just lying on the sidewalk. So, if we accept that it's almost impossible to consistently find that one magical stock, that needle in the haystack, well, the logical thing to do is to just stop looking. Instead, you just buy the whole haystack. Okay, so how in the world do you buy the haystack? Well, that's what we're talking about now. We're going to look at the actual tools you use, things called indexes and exchange-traded funds, or ETFs. These are the Lego bricks you use to build your portfolio. I love this analogy. Think of the stock market like a roulette wheel. In a casino, over time, the house always wins. The odds are stacked against you. But the stock market is different. It's a game that's expected to go up over the long run, thanks to human innovation and growth. It's like a roulette wheel that's rigged in your favor. So you don't bet on just one number, you put a chip on every single number on the board. So the first tool is the index. An index is really just a list, a recipe. It's a theoretical shopping basket of stocks that represents a slice of the market. You've probably heard of the S&P 500. That's just an index, a list of the 500 biggest US companies. The key thing is, an index is just a concept. You can't buy it directly. So, if the index is the recipe, the ETF is the cake you can actually buy and eat. An ETF is a fund that does the work for you. It goes out and buys all the stocks on that index's list, and then it bundles them all up into one little package that you can buy and sell on the stock exchange, just like a single share of a company. It's how you buy that whole basket of stocks in one go. Now you'll find there are often lots of different ETFs that all track the very same index, so which one do you pick? You just need to look at a few key details. Domicile is where it's legally based. For investors outside the US, places like Ireland can be more tax-friendly. Cost is the annual fee, and yep, lower is always better. Size just tells you how much money is in the fund. Bigger is usually a good sign. And replication is how it tracks the index. We generally prefer physical because it means the fund actually owns the stocks. Okay, so we have our tools, our Lego bricks. Now we need the instruction manual. We need a strategy. And that brings us to the single most important decision you're going to make as an investor, your asset allocation. Asset allocation sounds technical, but it just means how you split up your money between different kinds of investments. And honestly, this one decision, how you mix things up, will have a bigger impact on your results than pretty much anything else. It's the main driver of how much your portfolio grows and how bumpy the ride is along the way. For a simple, long-term portfolio, it really boils down to two main ingredients. First, you've got stocks. Think of these as the gas pedal in your car. They're the engine of growth, but they also come with more risk. Then you have bonds. Bonds are like your brakes, or maybe your suspension. Their job is to add stability and smooth out the ride when the stock market gets crazy. They're lower risk, which also means they have lower expected returns. And what's really cool is how simple a powerful portfolio can be. This is a classic example for a younger person with a long time to invest. 80% of your money in a global stock ETF and 20% in a global bond ETF. That's it. With just two purchases, you own a slice of thousands of companies and governments all over the world. It's simple, it's diversified, and it's incredibly effective. But, and this is a really big but, that 80-20 split is just an example. It's not a magic formula for everyone. Your personal mix has to be based on your life, your age, what you're saving for, and how you feel about risk. As a general rule, the more time you have, the more you can lean on that stock market gas pedal. Okay, that was a lot of theory. I get it. So for our last section, let's make this super practical. Let's turn all this knowledge into actual action. It's time to talk about your first steps. The process itself can seem really intimidating, but I promise you it's surprisingly simple. Step 1, you open an account with a low-cost online broker. Step 2, you put money in it, usually just a simple bank transfer. Step 3, you use their search bar to find the ETF you want, using its special code, called a ticker or an ISIN. And Step 4, you hit the buy button. That's really it. A few clicks and all this theory becomes a reality. So let's just take a breath and look back at the journey we've been on. We started where it matters most, with your personal finances, not with picking stocks. We chose the simple, powerful philosophy of owning the whole market. We learned that ETFs are the perfect tools for the job. We figured out how to create a simple strategy with asset allocation, and now you know the exact practical steps to get started. You know, the goal here was never to give you all the answers. It was to give you the right framework so you can start asking the right questions for yourself and begin your own journey with confidence. So, the knowledge is yours now. The only real question left is the one on the screen. Now that you know the concepts, what is your first step?